Mark Twain had a very specific warning about the stock market. He said that October is a peculiarly dangerous month to speculate in stocks. The other dangerous months are July, January, September, April, November, May, March, June, December, August, and February. People have always known that treating the market like a casino often turns kings into paupers just as fast as it turns paupers into kings. Yet, the historical record shows that the human urge to get rich overnight never actually fades. This leaves us with a massive contradiction at the center of global finance. Are market prices actually dictated by the cold mathematical reality of a business, or are they driven by the psychological fantasy of human greed? How you answer that question splits the financial world into two warring schools of thought. The first approach is the firm foundation theory. It argues that a stock's true value is anchored to tangible metrics: a company's total revenue, its profit margins, the quality of its management, and the cash dividends it pays out. If a $50 share generates better, safer returns than a bank account, a firm foundation investor buys it. But what if that same share costs $70, wiping out any logical yield advantage? The firm foundation investor walks away. The opposing side, however, buys it anyway. This is the castle in the air theory. Here, the underlying dividend doesn't matter. The only thing that matters is the belief that a crowd of eager buyers will soon push the price to $100. The most famous champion of this speculative approach was the legendary economist John Maynard Keynes. To explain how markets really work, Keynes pointed to a popular newspaper competition of his era, where readers had to select the 6 prettiest faces from 100 photographs. The winner wasn't the person who picked the faces they personally found the most beautiful. The winner was the person who correctly guessed which faces the rest of the readers would vote for. Keynes applied this exact logic to the stock market. Because future business profits are always uncertain, he argued you should base your trades entirely on anticipating the mood of the crowd. He practiced what he preached, spending half an hour every morning trading from his bed and amassing a fortune of over £1 million. But this psychological game has a dark side. When an entire market values assets based purely on what they think someone else will pay tomorrow, prices detach from reality, inflating the financial bubbles that have defined market history. To see how destructive this crowd psychology gets, we have to look back to the 17th century Dutch Republic, the site of the first major speculative mania. Botanists had imported tulips from Turkey. Shortly after, a mosaic virus infected the local crops, creating striking, multicolored patterns on the petals. The rarer the pattern, the more people wanted them. The value of the flower completely detached from any practical use. Total societal madness set in. Fishermen, farmers, and wealthy nobles began liquidating land, homes, and family jewels just to buy tulip bulbs, assuming prices would rise forever. In one infamous case, a sailor accidentally ate a merchant's tulip bulb, thinking it was an onion. That single onion was worth the equivalent of a ship crew's entire yearly wages. When the crowd finally stopped buying, prices cratered, taking thousands of family fortunes down with them. This speculative disease repeats itself. It appeared again in the 1700s with the South Sea Bubble, where British investors poured their life savings into a trading company that had virtually zero actual trade. It crossed the ocean during the 1920s Florida land boom. A piece of land in Palm Beach bought for $800,000 in 1923 was chopped up and sold for $4 million just 2 years later. At the peak of the frenzy, roughly 1 out of every 3 people living in Miami was working as a real estate broker. Whether it's a flower bulb, a shipping route, or a swamp, the pattern is identical. The human desire to get rich quick consistently overrides rational mathematical valuation. Which brings us to the roaring 1920s stock market. Driven by widespread margin lending and pure expectation, the market became a massive castle in the air, detached from any rational economic anchor. Then, in the fall of 1929, the music stopped. A few investors took their profits. The crowd noticed, stopped buying, and panicked. Because the high prices were supported by psychological belief rather than actual corporate profits, billions of dollars in imaginary wealth vanished into thin air. The implosion of this speculative game shattered the banking system and triggered the Great Depression. Millions of people lost their savings, suicides spiked, and the country was left destitute. When you build a financial castle out of nothing but crowd expectation, economic reality will eventually tear it down. Out of the wreckage of the 1929 crash, a new, highly disciplined approach to the stock market emerged. It completely rejected Keynes and his beauty contest. The architect of this shift was a Columbia University professor named Benjamin Graham. Known today as the father of value investing, Graham resurrected the firm foundation theory, arguing it was the only reliable mechanism for protecting capital. Graham didn't try to guess the mood of the market. After some of his clients lost money in the initial crash, he didn't panic or gamble to win it back. Instead, he spent the next 6 years managing their accounts for free, using strict mathematics to slowly repair their portfolios. Graham, along with contemporaries like John Templeton, formalized a concrete rulebook. Their strategy was to find ignored companies that the crowd hated, buy their shares at a steep discount to their actual intrinsic worth, and patiently hold them, often for years, until the market recognized their true value. By tying every decision to measurable assets and cash flows, Graham provided a mathematical framework designed to withstand market hysteria. Graham's most famous student took these exact firm foundation principles and proved them on a massive scale. His name is Warren Buffett. Having bought his first stock at age 11, Buffett built his career on ignoring the daily noise of Wall Street. He rejects the quick thrills of day trading entirely. As he famously put it, his favorite holding period is forever. By refusing to participate in the frantic pursuit of instant wealth, and instead slowly compounding the profits of solid businesses, Buffett became one of the wealthiest people on Earth. Yet despite commanding a fortune that once surpassed $180 billion, he drives an older car, lives in the same modest house he bought decades ago, and eats a remarkably simple diet. His lifestyle mirrors his investing, totally immune to external hysteria. Human nature guarantees that there will always be a crowd eager to build castles in the air, chasing the next tulip bulb or hot stock. But history shows that the only fortunes that survive the crash are the ones built quietly on a firm foundation.